Hello everyone, welcome to today's US Open live webinar. It is Tuesday, May the 16th, 10 minutes before Wall Street opens. As always, I am our host Nikos Zavouras, Senior Market Specialist at FXCM. So sentiment has been a bit cautious today as markets contemplated economic indicators from China that were not as good as markets wanted. Earlier today, we had economic indicators from the United States as well, which, even if not particularly robust, are encouraging. And at the start of the day, we also got employment data from the United Kingdom, and of course, we also have the debt ceiling that still looms over markets, as we don't have any resolution yet, although negotiations are expected to restart today. Before we get into today's session, however, as always, please read carefully through the risk warnings and the disclaimers, and then we will get started. Once again, please read carefully through the risk warnings and the disclaimers, and please note that anything discussed today does not constitute investment advice and should not be taken as such. Okay, let's get the ball rolling. We have your USD on our screen. Before we start with the technicals, let me just repeat that sentiment seems to be a bit cautious today. Again, we had a huge amount of data coming out from China, from the United Kingdom, from the United States, and the debt ceiling saga still looms above markets. And we also had already some important earnings releases from the United States and the UK, and more are expected throughout the week. We will start from with Euro USD. We'll talk about UK data and GBP USD. Then we will move into oil outlook and reference there the data from China and the upgraded projections from the International Energy Agency around demand. And then we will go to SPX 500, the US index, the broader US index, and round things off with what's ahead and make a quick reference there of the earnings releases from Home Depot in the US and Vodafone in the UK, and what's and more earnings that we expect over the next couple of days. So as I said, let's start with Euro USD. It recorded its worst week since September, largely due to risk aversion on US debt ceiling, regional banking fears, etc., themes that we have discussed in previous sessions as well. It ended the week below the key 200 period EMA. Here, this black line, and this creates risk for a test of the daily Ichimoku cloud and the ascending trend line from the 2022 multi-year lows. That's around 1.085, 1.077 region, but the downside seems well protected because the 200 days EMA, the regional highlighting here, also follows. In general, I continue to think that sustained weakness below this area is hard to justify given the policy rate differential. The ECB has pointed to more hikes while the Fed has hinted to a pause. Again, these are things that we have discussed and written about extensively. The common currency, however, finds support this week and has the ability to reclaim the 200 period EMA that would shift bias, immediate bias on the upside again, and give it the opportunity to look again towards 1.1096 and the 2023 highs, but a catalyst would probably be needed for such a move. Now let's go to GBP USD. The jobless rate inched up to 3.9% in the 3 months ended in March for the UK. That's the highest level in more than a year, and more to it, payroll employment decreased in April, registering the first fall since the COVID-19 pandemic. Now, the British pound reacted negatively to these figures, mostly because these are numbers that could potentially help the Bank of England become less aggressive, adopt a less aggressive stance. And of course, the broader cautious sentiment also weighed. However, wages remain elevated, and in fact, excluding bonuses, they rose 6.7% in the 3-month period that I referenced, and that does not help the effort to fight inflation. And in any case, the Bank of England has clearly kept the door open to more tightening while upgrading inflation and GDP forecasts and lowering those for unemployment. These are themes we talked about on our last session on Thursday. Now, last week's decline has created scope for further losses towards 1.23, 1.2273, but again, there seems to be a strong area of support there, and a strong catalyst would be required for further losses past 1.217. Monetary policy. As we said, the BOE has kept more hikes on the table, and that can help the pair, whereas the Fed has already hinted to a pause, and that can be supportive for the pair. And we can see that it had defended the 200 period EMA last week and defended it again during the pressures that it faced after the UK jobs report. So above that region, it has the ability to push for new 2023 highs, current at 1.2680, but the next major resistance at 1.2948 looks distant. Now let's switch gears and move over to US oil. Now you can see that it's mixed today because it had to sort of digest competing factors. On the one hand, we have the latest data from China, which was for industrial production and retail sales, which although were robust, they were less than expected. The market did not like that. And of course, this came after data released from a few days earlier, which showed very limited increase in inflation, which pointed to weak consumer demand and another contraction in the manufacturing PMI. On the other hand, today the International Energy Agency upgraded its 2023 oil demand outlook, now expecting it to grow by 2.2 million barrels per day compared to 2 million previously. Of course, this will be largely driven by China's rebound, which the agency believes is even stronger than previously expected, and is projected to account for 60% of the global demand growth. Now, given this, and of course, potential contraction is applied due to the OPEC plus output cuts. Given these factors, the recent low seems increasingly like a bottom, but the road to it is not closed. Even though US oil posted a sharp relief rally, it has failed to clear this critical region here, which includes the daily Ichimoku cloud and the 200-period exponential moving averages. It has the chance to do it, but it may need a fresh catalyst around that. As long as it does not do that, it still remains in a precarious position. And let's now go to SPX 500. Has been mixed for the last month or so, weighed by banking turmoil, fears of economic slowdown, and other headwinds. The lack of progress leaves it vulnerable to pressures towards the 4,000 mark, but we're cautious for more losses below that region. The index has shown remarkably resilience, and of course is helped by the Fed's hint of a pause, and has managed to defend a critical technical region, which is the 38.2% Fibonacci of the last leg up, and has also formed a double bottom here, which all create expectations for new 2023 highs, but not so sure yet about challenging the 4,326 resistance. Now that's pretty much it for the tech, but we have quite a few things to talk about what's ahead and recent and upcoming earnings. We have Eurozone April final inflation on Wednesday. Preliminary data had shown an uptick to 7% and a marginal moderation in core. This is potentially worrisome result because if confirmed by the final data, of course, because headline inflation had been coming down slowly and core was sticky. Now there is a chance that headline will prove sticky as well. ECB noted that spoke of ongoing high inflation pressures last week, whereas yesterday the Euro Commission updated its inflation forecast to 5.8% in 2023 and 2.5% in 2024. Then we expect the Australian wage price index on Wednesday and the unemployment rate on Thursday. According to the RBA, the labour market is very tight and wages have picked up in response. So critical data as to the next steps of the Reserve Bank of Australia, which restarted its rate hike cycle this month after a pause. Now, investors continue to monitor the debt ceiling saga. We haven't seen any real progress yet, but talks are expected to restart today. Treasury Secretary Yellen had recently estimated that funds could run out as early as June 1, so we're moving fast towards that deadline. The Congressional Budget Office over the weekend said that if the government can manage to hold on until June 15, then it will be probably able to continue financing operations through at least the end of July. So some critical dates coming up. Now on the earnings front, retail giants Target and Walmart are in the spotlight over the next 2 days. Today, Home Depot reported the results that disappointed markets because it posted year-over-year drop in both its top and bottom lines, and it offered underwhelming guidance for the current fiscal 2023, which would be a year of moderations for the home improvement market, according to its CEO, Ted Decker. However, it's not only just US companies, but UK companies that are in the spotlight as well. This morning, telecommunication giant Vodafone announced a restructuring plan and massive job cuts of 11,000 people, and its stock dropped. While on Thursday, we expect luxury fashion firm Burberry, with China figures in focus, given the country's reopening and the fact that nearly 50% of Burberry's revenue came from the Asia Pacific region in the previous fiscal year. So that's pretty much it from me for today. Thank you for joining me. We will talk again on Thursday at the same time.